Hello everybody, Jackson here from the Wealth Squad. I hope you are doing well. Today we'll be talking about how to find the best dividend stocks for your portfolio. We're using a site called finviz.com. And then once you're here on the site, you can press screener and then you could press all and you'll be sent to this page with all of this criteria to be chosen. Of course, we're not going to use every single piece of info here. We're only going to choose 6 or 7 because there is a lot of companies go through. But if you pick the right criteria to decipher these stocks and narrow it down into a list of, 20, the chances of you find a good stock out of those 20 is a lot higher than, deciphering all of these and spending an efficient amount of time doing that. That's not going to work. We want to go through 20 stocks max. And go through those and see which ones we could pick from there that we can invest in for dividends. So before we start, just note that it's kind of based on preference, right? I said in the last video, I'll say in this video, but right away I'm going to choose my country as USA. That's because I'm in the US. If you're more familiar with another country, feel free to choose those if you think there are good companies in that country paying a strong dividend. But since I'm custom to the US, I'm going to choose the US because it's better fit for me. Next would be, so you can see right actually, our list is already down 1,100. It's at 8,200, now it's at 7,100. We pressed one thing. So next, I like to choose a market cap above $2 billion. So it's plus mid, and now we're at 1750. Only using 2 options. From there, these are all American companies worth more than $2 billion. From here, I like to choose a dividend yield. This is where it's based on preference, again, right? Dividend yield over 2%. Now, a lot of people will be like, why so low? But you have to realize a lot of tech stocks have gone up so much over the past couple of years, or just past, year and a half, that the dividend yield will shrink. It'll still pay a strong dividend, but not as much as it did, a year and a half ago or before then. So we have to account for that. And also because a lot of tech stocks pay a small dividend to start. I guarantee most of them don't pay over 2%. But this way we can have more a grasp of growing companies rather than stable, right? So over 2%. Then I like to choose a payout ratio under 60-70. For this, I'll choose 70. And a payout ratio simply means that the company, let's say they earn $1, right, in profit. A payout ratio of 70% means that they're paying 70 cents of their dollar profit to shareholders as a dividend. They're keeping that 30 cents and reinvesting it back into the company. Now, the lower your payout ratio, I chose over 70. I meant under 70, under 70%. Now, under 70% means that companies ranging from 0, I guess it won't be 0, but be like, 1 at least, to 70%, that's their payout ratio. We don't want anything over 70%. That seems kind of non-growth oriented, right? If they're paying 85 or 90%, they're only saving 15 to 10% to reinvest in the company. We want more of a growing company rather than stable for now. In my case, yours could change. From here, we can choose the ROE, return on equity, of plus 15%. Now, this stuff is kind of basic: market cap, dividend yield, payout ratio, country. Now, the ROE is return on equity. That simply means that, if we're choosing 15%, how much profit the company can generate per dollar invested, 15 cents, right? If we're choosing, negative, of course, that's a bad company. If we're choosing, 2%, that means every dollar invested to the company, we get 2% back as shareholders. That's not good. It's not including the dividends, just the equity building of the company. Every dollar that the company earns, they return 15 cents to shareholders in the form of equity. That's what this means, over 15%, right? So that's the minimum they could provide back. The higher ROE, the more efficient the company is in giving out or is growing their assets. But if their debt is super high, then it's kind of counterintuitive, right? Counterproductive, maybe. So we want to get a debt ratio in there as well, just to make sure they maintain that debt. Because a company could have a super high ROE, but have an insane amount of debt. And we wouldn't know unless we have a debt ratio in there. So let's put this in here. I think we chose under 0.6, 0.7, okay. Now this means every dollar invested, the company has, in this case, 70 cents in debt, right? So the lower the debt equity ratio, so we chose under, so it could be 0.1 if it wanted to. The lower, the less risky, and the higher, the more leveraged, more risky. So if the debt equity ratio, let's say, is 1.5, that means that they are way more leveraged. They have $1.50 of debt per dollar of equity. That's not very safe for dividend investors or investors in general. So keep that in mind. Under 0.7 is where I think we should be at. So we have 31 options left. And then the current ratio is the last thing, the last criteria I like to put on here. Over 1.5, which just means the company has more current assets, 1.5 more current assets than current liabilities. The word current just means, current assets, they mean that it could be liquidated within a year, right? So it could be some assets, some machinery, where they could sell it within a year, get their money back, pay their debts. Over 1.5 means that the company is in good financial health. Just like that, just by choosing 1, 2, 3, 4, 5, 6, 7 different criteria to narrow down our search, we have 15 options. And you could see some companies that you could recognize, like Cisco, Intel, Texas Instruments, APD, Cummins, Snap-on, Buckle. I've heard of a couple of these. Evercore maybe. But from these options, we could just look at them briefly, see what they're all about. Of course, you can see right here, the lower PE ratio, generally the better. Without going into too much detail, we could try to cut some of these off already, right? I would choose the basic material stuff like chemicals, maybe not chemicals, but copper for sure. That's based on a larger ground, higher than just stocks. It's based on commodities, right? Same with like oil and stuff, but we don't see too much of that here. So I'd cross off copper, right? I don't want to be in a business where the price of a commodity determines whether the company makes money or not. So I'll cut this out. Let's check the valuation of some of these. EPS growth, not too good. EPS is earnings per share. I would also choose, just based off what I know, I would cross off Intel because I know they're in the losing game. It's kind of like IBM a couple years ago. It's just the company's starting to slow. More competitors are starting to grow in the space, like NVIDIA and AMD. I would stay out of that space, especially by not investing in Intel, even though their numbers look good based just on the surface. That's just my opinion, right? But yeah, just from here, you can see a whole bunch of different stocks, just 2%. So that's why I chose that 2% yield, because I know so many aren't that high right now. So yeah, it does look like Texas Instruments is pretty good, actually. But I'll leave this up to you. All I know is this screener will change every day or so, right? Because stocks either fall under a certain valuation where the screener picks them up, or they get their financial health in order, they get their debt back in order, and they'll appear on the screener. So make sure to check the screener once every couple weeks maybe every week. You could change this, however, based on what you like, what you decide for yourself. This is just what I like. So I'll look through these and see what I like, you know, if anything. If not, I'll just keep the screener up, check it, you know, occasionally, see if anything new pops up and grabs my attention. So that's about it for today's video. I hope I could help you, you know, find your own dividend stocks. If I did, please leave a like on this video. That helps out the channel a lot. And I'll see you Monday. That's when I post a new video. Get money, buy income. Make sure to sign up to the Wealth Squad. Link is in the bio. Grab the merch as well. My other shirts and stuff are on the way, so I'll get those soon and wear them. But besides that, thanks for watching. Have a great night.